All right, guys, my name is Ryan Schul. Welcome to my channel. In the topic today, I want to talk about cryptocurrency volatility and do some anomaly detection. Okay, so this is going to be pretty cool. I'm going to show you a couple different techniques on how to do anomaly detection. And then at the end, I'm going to create a couple algorithms to help us basically pick some good trading strategies. Okay, and I'll preface all this by saying this is not investment advice. Okay, investing in the stock market can be a risky endeavor. Okay, you can lose money. I'm not telling you what to do with your money. Don't try to sue me or come after me or get angry if you lose money in the market. I'm not telling you what to do here. I'm just telling you mathematically how this stuff works and statistically how everything operates. Okay, and we'll look at some interesting cryptocurrency investments or trading strategies, but that's it. Okay, this is not investment advice, so don't take it as that. Now, why would we even want to do this kind of analysis? Basically, to help us detect market manipulation or some type of volatile activity in the market, something that's very choppy or high standard deviation, high movement in the market. If we want to be aware of that, this is a great way to do that. Early pricing system or early price warning system, that's very important too. Maybe there's regulatory changes and announcements that come out, insider trading activity. You shouldn't be doing that stuff, but some people do it anyways. Major liquidation, what's it called? Investment or divestment, something like that. So this will show us if those activities are being undertaken, right? And we can overall improve our trading strategies, right? Make more efficient trades, make more intelligent trades, more optimized type of trades, okay? Portfolio risk management. So this technique or these techniques I'm going to show you are great for that. Again, understanding the volatility and the metrics behind that, looking into different anomaly patterns and helping, trying to help us to understand that. That's important as well. Investor sentiment monitoring. Okay, how do people feel? What's the psychology of investors? Investing psychology is very, very, very fascinating. I love that topic, right? Because the market doesn't necessarily do what you think it's going to do. It does what most of the investors are doing, right? The trend is your friend. That's the old saying. So if there's a big trend, whatever it is, that can be your friend, right? But if you try to go against the market, you can be right, and 99% of people can be wrong. But what's the old saying? The market can remain irrational longer than you can remain solvent. Okay, if you reach a solvency, you're basically bankrupt. And you can be right. You can be right. I've seen people lose millions of dollars, and they were right ultimately, but the timing was wrong, and just the opportunities are wrong at that point in time. So what else? Investor sentiment monitoring and educational and research applications. That's what we're doing today. So I'm going to go ahead and import some data from Yahoo Finance. I have 4 tickers here. So this is Bitcoin, ETHD, SOL, and DOGE. So you might be familiar with some of these, maybe not, but these are some of the more popular tickers for cryptos. And there's a bunch of them. If I Google it, I don't even know what all these are. Market equities, little fixed income, not so much crypto. What do they have? Crypto tickers. Tickers. We get all our data from Yahoo Finance. So it has to be on Yahoo Finance, or we can't even pull it. BT, yeah, we have that one. I thought there's a few others. Maybe not. I mean, I don't want to go down a big rabbit hole here. Oh, crypto. Oh, okay, so this could be it. Okay, so we have a few. So we have SOL, Dodge. So if you want to get a big comprehensive list, this looks like, what? Are you kidding me? 9,490? Am I seeing that right? I had no idea. 9,490 cryptos? Holy cow. Like, I totally learned something new today. I did not know. Oh, but some of these, maybe these are different. What some of these things are? Tokens or Binance or something? Okay, so there's a bunch of them. Anyways, so I have 4. It has to be on Yahoo Finance. If you want to play around with some of these others, by all means, go for it. Okay, so the way I designed this code and the way I designed practically all my code, it's very dynamic. It's very scalable up and out. All you have to do is change the tickers and then the time period that you're looking at. So here we're going back in time, 36 months. So this is 3 years, obviously. I don't think I have to explain that. We're going back in time 36 months, and we're looking at these 4 tickers. Now, if you want to go back 12 months, 18 months, 24, 36, if you want to go about 5 years at 60 months, you pick that, right? That's up to you. I think 36 is good in this case. These are the 4 tickers that I am focusing on. But again, if there's something that you're passionate about that comes from this list, I know there's 9,490, 9,500 of these things. Kind of blown away by that. But so if you want to pick different ones, just plug them in here. That's the point. So we're going to go back in time 3 years, import this data, and pull back all the historical closing prices for each one of these 4 tickers. Okay, so that's what this is doing pretty fast. So in a couple seconds, we have everything we need. Here is the data frame head, okay, and here's the data frame tail. And I won't go into all the details. I have this code in a couple of my videos when I pull this for other historical stock data, pricing, stock returns, things like that. For ticker and tickers, we go through the list of items we go through all the items in this list. This is a list evidenced by the square brackets here. So for ticker and tickers, we're going through making a fetch to the Yahoo endpoint, going from the start date, which is basically current date time, so today. So we'll get today's stock price as long as the market is open. We'll get the real-time price. And we're pulling back 2 features here, the date and then the closing price. So the close comes from here. This is the date. And everything looks like this. So we have the date as the index. You can tell that's the index right here because it's kind of like cut down one level lower than this level over here. And then the tickers are on the top, right? So going across the top, and then the dates are going down. So this is pretty standard, normal way of viewing the data, interacting with the data, plotting it, even saving it in a database. You'll typically see this view. You can maybe have I guess you can have the date and the ticker as 2 columns, and then the price is now that would make sense. This is pretty much a standard way of doing it. I think I've seen 1 or 2 alternatives, but this is normal. This is how you usually do it. Okay, so now I'm going to look at a concept called isolation forest. So we're going to look at the n smallest items in this list, and the anomaly score is actually looking at the smallest because in the isolation forest world, okay, in this universe, the lower or the more negative the amounts means the anomaly score is more likely to point to a larger anomaly. So even though it says n smallest, and we're looking at the top 10 of the smallest, again, the lower, the more negative scores, the smaller scores are actually the more anomalous. I hope I'm saying that right. More higher anomaly features or higher anomaly enrichment or whatever it is. So basically, we're taking everything from the data frame. Okay, this comes from over here, final data. If I go Control F, Control V, but then over here you can see final data comes from here. So we're going for ticker in final data columns. This is column 1, column 2, column 3, column 4. We are copying all that information into a data frame and then basically taking the data frame and assigning a score based on the closing price. Is this going to be an anomaly? So this is the decision function from the isolation forest algorithm. Basically, we assign an anomaly score, and if the score equals -1, then this is considered an anomaly. So if we look over here, we see the anomaly score. Okay, so we have the closing price, and then we're looking at, again, the 10 smallest, which are actually the largest type of anomalies. So it sounds a little bit counterintuitive, but that's how this isolation forest works. Okay, so here is the anomaly score right here. So -0.12, this is the smallest, but it's actually the biggest anomaly score. You look for the biggest negative. So there's the top 10, and this is for Bitcoin. So BTC is Bitcoin. For ETH, honestly, I'm not a crypto expert here, so I don't know what that is. ETH is Ether or something. I'm not even sure what that is. I have to look it up. But you can see the 10 smallest for that, right? So it goes in descending order. For SOL, again, in this space, my ignorance exceeds my intelligence. I know the math and the stats and the computer science and data science. I don't know what SOL is per se, but that's one of the bigger ones. I found that on this list over here, so you can take a look at that. and get educated. You can educate yourself in SOL. I think it's sort of this list over here somewhere. Maybe not. Maybe this is the second page. I swear it's somewhere. Anyways, yeah, I'm not seeing it now. Looks like this page is kind of freezing up on me, so I don't want to go down the big path and like crash this system. The computer is old and feeble, right, just like me. So I'm not going to push my fate here or test my fate, whatever. So here's Sol. You have the 10 biggest anomalies, and then Dodge. That sounds like Dogecoin. I think that thing has the dog's head on it. I'm pretty sure. But again, I'm not an expert in this area. So that's the top 10 using isolation forest. And again, the isolation forest is a technique that helps us determine what's an anomaly, what is an outlier, what is mostly different from most of the data set, right? We're looking for anomalies, high movement in these cryptocurrency prices, what is the biggest deviation from the normal mean, which would be the average, right? So this gives us that view. So we can go ahead and plot this out. So I'm going to have these 4 tickers over here and 4 ticker and tickers. So we enumerate through the tickers to go ahead and create the plot. This is called a matplotlib type of plot. So it goes ahead based on the closing prices. It shows us Bitcoin, ETH, SOL, and then Dodge. So we have 4 there. Bitcoin by and far is the most volatile and the most expensive or highest price, right, relative to the others. These are kind of flat, kind of compressed in here. So I also created a plot using Plotly. Normally I use only Plotly. I could probably do away with this. I don't even know if I use the matplotlib in this case, because Plotly is similar. The interface and the coding is slightly different than what you would see for Plotly. I'm sorry, Plotly is different than what you would see for MATLAB, but fundamentally it's kind of the same thing. The big difference is that it's dynamic and it's interactive. And when you put the mouse over it, you have these bubbles that pop up, or you have the tooltips that pop up. Right, so based on tooltip, we can see all the details. So Bitcoin is down to 26K, 29.2. So that's very nice. We don't have any of that with Matplotlib, right? It's very static, not interactive. I can't zoom in. I can't do anything with that, right? If I get into my Plotly chart over here, I can zoom in and I can see all the details right here, okay? So it's very nice, very interactive. It is, it does take a little bit more time to learn this kind of coding technique, and it is more involved, a little bit more complicated, but I think the time that you put in is going to generate huge gains in terms of payoff for the interactivity, the bubbles that pop up, the tooltips. You can zoom in down here. You can see the details of these charts down here. So now I can see this is ETH in green and SOL, and then Dodge right over here. So Dodge is just about 0.27 cents. So 27 cents. It sounds like it's pretty much useless. SOL is about 147. That seems a little pricey. ETH is 3,731. I can't even afford one of those. And Bitcoin is at 119,000 now. So there's no way I could get into the Bitcoin scene. That's absolutely mathematically impossible. But anyways, the point is these Plotly charts are very nice. They're interactive. They're dynamic. You can zoom in. You can zoom out. You can see all the details here, right? You can zoom into this range if that's what you need to do, and then see all of the nuances of that code, right? And for something like this that has very different scales, like the Bitcoin scale is up to 100,000. I think this is 100,000 for one Bitcoin. I guess that's how this works. But if you look at these others down here, they're pretty tiny, right? They kind of get like lost down here. But because this plot is interactive, we can zoom in and we can see all the details. Or I guess you could actually unclick this Bitcoin right here. Oh, we still have some of it, right? Okay, you can unclick that. That's why I love the interactivity of these charts, right? So you can actually like hide the Bitcoin and just see the details behind it. And if this thing is bothering you too, you can actually eliminate that and then just look at the details of these right here that are much smaller relative to the cousins, right? That are much more expensive. And then, of course, if you want to turn that off, you can turn that off. Then you see all the dynamic activity for this Dogecoin. So it's actually a lot. But on a scale of all of these, all these others 3, there's not that much to see for the Dodge, right? So anyways, that's Plotly, that's the chart. So let's move on. Now we're going to do an autoencoder detection methodology for all these tickers. So I just showed you isolation forest. I'm going to compare the two methods a little bit later. I have some notes that shows kind of side by side how these work. This is more of a deep learning sort of iterative process. It's called epochs. You run different epochs, which is almost like a loop. And within each loop or each epoch, you do a whole bunch of training. Let me see if I can find it. Okay, so epochs equals 50. So we have 50 sort of like training sessions, and that's one batch or one loop. And after the first epoch is done, then we go to number 2 and number 3 and number 4, and we do these in chunks or in batches, right? So here's the first one. The first one's done. I think there's like 5 of them that it has to go through. Then each time the model is trying to learn better and better and better how to go ahead and do this this type of anomaly detection, right? This is the other method. This is the second method. This is called autoencoder detection. Remember, the first time was isolation forest. So looking at the anomalies, all the outliers are, or outsiders, whatever you want to call it, right? Something that deviates from the norm, something that's kind of weird in terms of the price, right? These big price changes or big price fluctuations, if you have a big enough price change, that's going to trigger an anomaly event, right? And that's going to go into a different sort of bucket or a different category that's going to be determined or defined as an anomaly. So that's how isolation forest works. This is similar, but it uses a deep learning methodology, right? So we go through a bunch of epochs, 50 epochs for each train session. I think there's 5 total. Or is it 4? We'll see it when it finishes. This is step 2. And again, with each iteration, it's trying to learn more and more and more about these outliers and trying to refine the process of detecting outliers in an iterative fashion, right? So the outlier, the isolation forest did that pretty fast, pretty efficient, just saying, okay, it's beyond a certain score, it has a certain score, so it's going to be defined as an outlier or detected as an outlier. This process is a little bit different. It's using more like a deep learning, almost like a person would learn. Like you would look at all of the big price changes over time and then say, okay, this looks like an anomaly. This one looks like an anomaly. But for most cases, these are not anomalies, right? So an anomaly is something that's a little bit unusual, kind of a rare event, but that's what we want to try to find, right? These big price movements. And a little bit later in the code, I'm going to show you how to create some trading algorithms so we can use these strategies and these techniques to try to create a profit. Okay, so that is the goal here. Let this thing run. We're at number 4, and I think we go up to 4 or 5. When this thing is done, and it'll be done in a few seconds, then we're done here. And again, we're looking at 3 years of data. This is 36 months. We've trained the dense autoencoder per crypto, right? So it's 4. There's 4 that we're looking at, and we have detected anomalies using reconstruction error. This is part of the whole autoencoder detection process, right? And we store each result in the dictionary, again, based on the epoch looping process here, and then the outcome of each one. Okay, so that is what we're looking at here. And just for your own edification, we are scaling all of these too. So a scaling process is very important when you're using these type of anomaly detection processes, also for clustering. Like if you're doing k-means or any one of the clustering algorithms, there's like 8 or 9 of them, maybe 10. I'm not sure. There's a handful. You want to scale that data too, to take all of these outliers and everything that's kind of like out on the fringe and bring it relatively close to all the data points, but you still identify those as outliers. So it's not like you're taking everything and just pulling it into the middle, okay, and trying to make everything squeeze into the middle. It's not like that. But it is a good practice to scale the data. Otherwise, outliers could be treated wildly different. Like the computer knows to look for something that's different, but it still has to try to normalize everything and get everything kind of on the same scale, if that makes sense, and then it can do its analysis. If the scale is just all over the place, the computer is going to get confused, and probably humans will get confused too, right? If everything is just scattered and randomized, that's not going to be very helpful. We're trying to take everything and standardize it, but still identify like something that's an outlier is still an outlier, and if it's a high outlier or a low outlier, that's going to remain, but we want everything kind of in the same range, if that makes sense, in the same sort of standardization scaling range. So that's why we're doing the scaling here, the auto scaling. Okay, so I'm going to go ahead and get everything with the isolation forest into appended into my data frame. So I have data frame score IF. This is isolation forest. Data frame anomaly score IF. So we're going to merge these together, or bringing these together at this point, right? Because we have two techniques. I want to kind of combine everything together and then look based on these two techniques, these two methodologies here, whether it's isolation forest anomaly or the I'm calling it the autoencoder detection. I want those combined together, and then I can go ahead and look at true anomalies, right? So I'm going to go ahead and print this right now. So I have reconstruction error for Bitcoin, okay, for ETH, for SOL, and for Doge. Okay, so I have that, and I'm going to go ahead and plot the results. So I'm using Plotly again, like I showed you before, very dynamic, very interactive. You can zoom in, you zoom out, you have the tooltip that pops up. So very easy to work with these. And now we can see these anomalies right here, right? So anything that is flagged with a small red, whatever this thing is, what is this, an X or something? Yeah, I guess it's an X. If it has a small red X, that is determined to be an anomaly for this stock. Now you can see there's some anomalies over here, not for ETH. There's some ETH anomalies down here, So in this range, we kind of have anomalies in the same time frame, January 2023. So there's a lot of choppiness. There's a lot of weird things going on there. Although it doesn't look like it's very like it's a high bouncing anomaly. These might have been flagged because there's very low volatility. So you can see kind of a lot of volatility over here, choppiness. These are defined as anomalies right here, I guess because it's more volatile, and these are anomalous because they are kind of less volatile. So anyways, if it doesn't conform to the norm, that is triggered as an anomaly, right? If this is kind of like the same thing, then not an anomaly, right? So there's nothing to do there. And if you look above here, we saw kind of the same pattern over here, right? So the anomalies are flagged with this little red X over here. If you take it off, right, those disappear, you add it in and they show up. And you can see that the same kind of pattern down here, right? So anything that has a little red X is determined to be an anomaly. Otherwise, it is not. So, so the first one was what? This was, oh yeah, it's isolation forest. Yeah, that was the first technique. Second one, we're using the autoencoder detection. Then we're taking both methodologies, combining them together, right? So we have this chart here that shows everything relative to everything else. We have the four securities that we're looking at. So I think we're in good shape. So here's what we've done so far and how to kind of like digest all of this or assimilate all of this. We have the isolation forest. It's a tree-based ensemble method. So an ensemble means lots of different learning strategies or different modeling techniques all used together, and this is unsupervised. The autoencoder is a dense neural network based reconstruction, right? And this is also unsupervised learning, right? So more like clustering, classification, and regression is supervised learning when you know what the outcome should be and you're measuring the final results and making predictions and seeing how accurate those predictions are. With clustering and these isolation forests and the autoencoder, these are unsupervised, so you don't know what the outcome is going to be. The computer tells you, hey, Ryan, my name is Ryan. Hey, Ryan, this is an anomaly based on my determination, right? But I don't know that going into this. That's why it's unsupervised. I can't tell the computer what an anomaly is. It tells me. So that's why it's unsupervised, right? So isolation outliers are created using random splits. With the autoencoder, it learns and reconstructs normal patterns based on neural networks or deep learning. Isolation forest is fast. Autoencoder is slower, but probably more accurate, right? But then it also kind of depends on the type of data too. So the crypto use case, isolation forest is great for sudden price spikes, drops, or abnormal flatness. And autoencoders are good for modeling smooth trends and then detecting regime breaks or patterns or shifts in the data. And again, an autoencoder, because it's a neural network, it's probably better for discovering patterns and non-structured data, but all the stock data that we look at here is structured data, right? So you have a time or whatever, a date, you have a date, and you have a price, and that's it, right? Unstructured data would be like sensor data from a camera, so visual, pictures, videos, any kind of image. That's unstructured data. Anything that fits in columns and rows of a database or an Excel spreadsheet or a Google Excel sheet, whatever it's called, Google Sheets, I think, that is structured data, right? So let's move on to the next part here. So here's the first strategy. We're going to create 3 different strategies. Strategy A is buy in a dip. So we're looking for anomaly signals. If is anomaly, right? In the data frame, we defined what is an anomaly. So it's an outlier and data frame price percentage change less than 5%. We are going to determine that that is an anomaly, and we can go ahead and see where the anomalies are and determine if this is a buy signal or a sell signal, okay? And if for the anomalies, append, and this is buy, so if anomaly and price less than percent change 0.05, anomaly, we're going to buy these things, okay? And these are the tickers and then the dates that we should have done to buy on to maximize our profit. Strategy B, we're looking at anomaly signals, okay? And then for ticker and tickers, if is anomaly and percent price greater than 10% on the same day, now this is on the same day, 10% increase on one day, then there must be something driving this, right? There must be some activity, some choppiness, something driving the market, something simulating the market. This is a big thing here. If it goes up 10%, just sell and get out. You just made 10%, and let's take your money off the table, sell what you have, get out of that position, and lock in your trades, lock in your prices, like you're locking your profit, right? Okay, lock in your profit, and you walk away. So these are the big 10% moves in one day. We are recommending all sells for this price on this day. So 2024, 11/17 sol. If I go back to that, 11/17, 2024. Let me just take a look. 11/17, 2024. 11/17. Oh, here, it's going to be close to here. 11/17. So from 215 to 237. 237, 215. Let me look at this thing. 237, 215. There's a change right there. 10.23%. So 10.23% up. So that's why the model is recommending get out. You made your money, 10%. Well, I don't know how much you have in there. If you had 100,000, you just made 10,000 a day. Sell it and walk away, right? So strategy 3 is saying, let me go ahead and run. If for all the tickers, if both anomalies, right? So Isolation Forest and the other one, this is new for me. I have to go up and look at it. It just came up on my radar. I'll say Autoencoder. Okay, so Isolation Forest I've been working with for a while. This one's kind of newer for me. So if Isolation Forest and Autoencoder both determine that this is anomaly, if both anomaly for the Isolation Forest and the Autoencoder and both anomaly and price change less than 5% buy, if both and percentage change greater than 1, then sell, otherwise hold. So these are the trading strategies here, okay? So we're seeing on this date, the ticker is Bitcoin and not both anomalies, so just hold. And let's see, both anomalies are triggered, but not greater than 10%, so we hold. So these are all hold recommendations here. But if the percent change was greater than 10%, then if both anomalies occurred, then we would sell, otherwise we hold, okay? So that's why we get hold. Most of these are hold recommendations. And you can see over here, greater than 10%, it only happened 4 times, right? In 36 months, it only happened 4 times. Because the change has to be on the same day, right? And that's a big change, guys. It's big. So if it's a big change, sell it, otherwise hold. Now we can create a forward-looking confirmation-based rule. So everything was backward-looking. Those 3 strategies are what happened in the past to maximize our profits. But but let's say we just missed the boat, right? Like we're just getting into the game right now. Today is 7/24/2025. How do we use this historical information from the past where we saw 3 profitable trading strategies, but use that technique to profit on trades into the future, right? We can't go back in time. That's nonsense. That's non sequitur, right? That doesn't happen. But we can look forward in time using these trading strategies that we've just developed and confirmed, and try to use this to leverage this knowledge and to create profitable trading activities in the future. So for each detected anomaly, check if the price moves up or down by X%. You can determine that. It can be 5%, it can be 10%. 5% will be more common, 10% would be a little bit more rare. Just, you don't see too many 10% moves, 5% is more common. If price goes up by 10%, confirm a buy signal. If price drops by 10%, sell it. Okay, get out. The thing could be crashing. You don't want to get married to these cryptocurrencies. I guarantee it does not love you. You should not love it back. Don't ever love a stock because it doesn't love you. If it goes down 10%, that's a sell signal. Get out of it. You made the bad decision. Walk away. Okay, up 10% and you're in it, then buy it. This assumes that you hold it, right? If you're just a spectator or a bystander and you're just looking at it, doesn't matter, right? This assumes that you are invested, you're fully in, you're all in on these cryptos, right? Up 10%, that's a buy. Down 10%, that's a sell. Otherwise, just hold on to it. Okay, let me run this script right here. So that's what we're looking at here. We're looking at the price change and then the current price, and buy confirm or sell confirm. Everything is going into this future signals. This is a list that I created. If the max future return greater than the threshold, that's a buy. Else, if less than threshold, that is a sell. Okay, so we're selling everything and we're appending this into this list. We're appending these trading recommendations into a list. Otherwise, hold and confirm. And we can see the output right here. So it says hold, 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 sell, and then buy. I don't know if we need the confirm. It could just be buy, hold, sell. I think that's the same thing, right? Probably carried away with this, creating the same buy, hold, sell. I don't think we need that, right? I think that is just the recommendation, not the requirement. Let me see. Let me just run it. Yeah, that's fine. Okay. So buy, hold, sell. So pretty straightforward. And we can look at just the strategy filter. If the signal is in buy and sell and the confirm signal, the future signal is in buy confirm or sell confirm, then we can just filter these out and just look at these buy confirms, control enter, and it's actually none at this point. So none meets that. Oh, I know why, because I took that. I have to be careful when you make these changes on the fly. Sell confirm, that should work. Okay. Should be a couple. Yeah, buy, and then one sell recommendation. So we're filtering out the top recommendations here, and then we can visualize all the final results in Plotly. So let me run this, make sure that this thing runs. Okay, it looks good. Looks good. Okay. So we have the final visualization. Again, I really like these Plotly charts. They're dynamic, they're interactive. You have the buy signals right here from the DF buy. And if I print out the DF, you should see this pretty easily here. We have all the charts displaying everything. Let me just take a quick peek at this thing. Display. Let's look at the top and the bottom of this. Whoops, by default it goes head is the top 5 and tail is the bottom 5. Okay, here's the final data frame. So we have the price, reconstruction error is anomaly, score for isolation forest, score for anomaly, score for isolation forest is anomaly isolation forest, and then the stock ticker, and then both, right? So this is both the isolation forest and the let's say this other thing. I just came across this recently. Autoencoder, if they're both true, I want to know about that. And then the signal is to buy, hold, sell. So we have a bunch of holds over here. And the future signal, I remember the signal is in the past. The future signal is how to leverage that data, that knowledge that we gained from historical movements or historical patterns, and use that into the future. This is our buy, hold, sell recommendations into the future. Okay, so that's it. And we have a little bit of a reversal over here. So this is a price drop. This is a price drop for Dodge. This is for Sol. And then this would be a price gain or an entry. Recommended point to get into the stock would be that green uptick ticker. You see 3 of them right here. All right. But then that's why I said this is not trading advice, because the recommendation is to buy here. It actually goes up a little bit. but not a ton. Like you wouldn't make a lot of money. Then the recommendation is buy here. Again, based on historical activities and how we've trained these models and what has happened in the past. But then the forward price is kind of flat. And here's another buy indicator over here. And again, price is kind of flat. It does go up a little bit. Now, I guess you could argue if you buy at these 3 points into the future for the ETH, it did go up a lot. But then it came down a little bit, right? And then it comes down a lot over here, and then it kind of bounces up a little bit. For Bitcoin, it was more consistent. This is actually true. If you buy here, you're gonna become a king, I guess, because you have a ton of capital gains there. Here's a sell. That is actually a very good recommendation to sell, and then it drops off a precipice. And same thing here. Although if I look at this, this could be a mistake, maybe not in the code and not in the recommendation. It's just doing what it's trying to do. But the price kind of dropped off a cliff right after a buy recommendation was inserted here. So this is actually correct, right? Because it drops, then it bounces up, then it gets here. A buy recommendation comes from the model that we just trained and tested, but then it actually falls off a cliff and you actually lose a lot of money. So that's why I'm saying this is not investment advice. This is mathematics, this is statistics, this is computer science, this is data science, this is financial education, maybe even financial engineering. It's very interesting stuff, but it's not investment advice, right? So in some cases, you buy here, you would have made a ton, sell here, that's a good recommendation. Buy here, and you actually lose. This is a good recommendation. Buy here, sell, this is a sell, right? And you save yourself a lot of anxiety right there. These are good buys. Buy and hold, you would have made a ton. And buy over here and hold. You bought on November 9th, 2022 at 15,000, and now you have 119,000. You just made $100,000 per share. I can't afford too many shares at $15,000 per. That's how much my car costs. I can have a car or one cryptocurrency token or whatever these things are called. I take the car over the crypto, but just me personally. But if you did invest in this crypto, you'd make 100,000 per token or coin, whatever these things are called. And then I don't know if you had 10 at 100,000, you would have made $1 million. You would have made $1 million, right? So, or you could have a car. I guess I'm kind of risk adverse. I would take the car, but that's why I'm not a millionaire. Car owner, not a millionaire though. So that's it, guys. The video is hitting 37 minutes now. I would like to keep it under 40. I don't think it needs 40 minutes to dissect this and to break it apart. I think we did justice here. I think we did a good job. I'm going to save the changes. Okay. 2 seconds ago, the changes are saved and we are good to go. I'm going to export this code as an HTML file. I'm going to upload the code when I post the video a little bit later today. So I'll have access to everything that I have here. You'll have all the code. You can download it, put in your own Bitcoins, do your own analysis, change that 36 months to whatever you want, 12 months if that's what you need, 2 years or 5 or 6 years, whatever you want, right? You can change it to be whatever you want. I think 3 is good in this case. We capture enough historical information to see all the price deviations over time. Obviously you go back further and you pick up more. If you go back too much, 10 years or more, I don't think that's going to be super helpful. I think these shorter durations of analysis are more practical than longer. If you go back a year, 2, 3, I think it's totally fine. What was happening 10 years ago is not very relevant to what's happening right now today. What's happening a couple of years ago or a few years ago is more relevant. What's happening a few months ago is very relevant to today. If you go back 10 years of time, that's not going to help you too much with your analysis. It's become more noise and more useless information rather than useful information, right? I think 2 to 3 years is a good time frame for this type of analysis. So that's it, guys. I'm going to wrap it up here. We're almost at 40 minutes. So if you have comments, suggestions, post it in the comments section below. I'm going to wrap up the video right now. I will post all the code when I post the video, and I'll see you guys shortly when I post the next video, which will be very soon. Okay, thank you, and take care.